Welcome to another chat with Avid. David Harpole, as always, here with Jack Arnold. Good to see you, Jack.
Good to see you, Dave.
So we are halfway through December. We're closing in on the end of what I guess, cap as a wild year. And we want to share some thoughts with you as things have unfolded, both as an economic standpoint here in the U.S., globally, with the pandemic, as we're all aware, but also financially in the markets. And we want to talk about what that looks like, what we all experienced, and points really to keep in mind, as a lot of this stuff is unknown and uncontrollable. And we could talk about this for 3 hours probably, Jack. But I don't think anybody wants to listen to us that long. So just keep in mind, we're going to try to hit a lot of the high points. If there's things you want us specifically to focus on, your individual situations, let us know and we'll address those whenever we can, for sure.
Yeah. I would also say, there's no shortage of forward-looking, here's what's going to happen type stuff. Like if you're looking for people guessing what's going to go on in the market, or like tons of market talk, like there's plenty of outlets that will give you that. So we're going to try not to do that. We're going to try to talk a little bit about what had happened, but also point out some things that actually matter to you as an individual investor, not just these really broad-based things that don't have any real applicability to your personal life. So we're going to try to do that and not make this a super dry, here's what happened and here's what might happen, which is, there's a million of those. So
good point. Totally agree. Let's just kind of recap. I mean, I think, obviously COVID has been the topic of the year, but I think it's interesting to even think just from a psychological standpoint, prior to COVID, we came off of a 2019 that was pretty amazing for all intents and purposes. U.S. economy is doing good. The global economy and markets, as we manage accounts outside of here, and let me preface this as we have to, because we talk a little bit about investments here. This isn't a pitch for investments. This isn't a solicitation for a product. This is purely knowledge-based, informational only. Investments come with risk. So there's our AVID disclaimer. But 19 was really a great year. And from a business standpoint, a lot of personal conversations we've had with people, there wasn't a whole lot of uncertainty with 2020 outside of maybe we knew there was an election, there was possibly a change, and there was some uncertainty there. But otherwise, I think everybody was feeling pretty good about 2020.
Yeah. There wasn't there's always a little, what's going to happen type uncertainty, but there certainly wasn't we weren't coming off some kind of major event that was like, how's the market going to react? Definitely the election thing is always like a big topic. We knew that was coming. We definitely did not think, man, we're going to have some pandemic thing, which I think is more illustrative of there's more crazy things that can happen than you can even imagine. So trying to foresee or guess what's going to happen, and then somehow today making your investment decisions based on some kind of clairvoyance about, this is going to happen in the future. If anything should show you that crazy things can happen, which we'll talk about a little bit more in depth, is this is the year that can show you crazy things can happen just in general, as far as like Corona, but also the reaction to those things a lot of times is very counterintuitive. So even if you get the event right, you can get the positioning, I guess, wrong as far as like how the market would react. So we'll talk about that for sure.
Yeah, no doubt about it. So you enter into a year, high hopes, if you will, and then really right off the bat in January, COVID came about. We were kind of alerted by it. There were warning signs. It turned into travel bans, restrictions. And then really as we got into the spring, if you will, March, April, May, the landscape of life as we knew it, to include the market, was literally just a wildfire. No pun intended, but it was crazy. Things were literally, the sky was falling in terms of markets.
Yeah, right. It's funny that you say wildfire. I guess maybe it's not so funny, but it's interesting that I guess maybe this is every year. There's always big things that are going on. But if you really think about some of the things that happened this year, it's insane. Like, whether or not you're a big basketball fan or not, but like having like the year being kicked off with Kobe Bryant dying in a helicopter crash is incredible. Obviously, famous celebrities and athletes pass away all the time, but not somebody at that level in that fashion. Like it was just insane. And that seemed like a lifetime ago. And that was in January. So it's that. And then we had Corona, which is the obvious, this crazy election situation, which was maybe we kind of knew it would be a little bit crazy, but then you have the wildfires in California, which is, I think, the most widespread wildfires they've had ever, or something along those lines, at least as long as it's been as populated as it is. We're making our way halfway through the Greek alphabet in hurricanes. It's like every time you turned around, there was something that was unprecedented that was happening, and not unprecedented in an odd kind of way, unprecedented in an extreme type of way. So like you said, if there was ever a year that would have you question your ability to predict what's going to happen in the future and then position your portfolio in a way that could take advantage of it, this would be the year to tell you that this stuff is just wild, just all over the place. And you're just wasting your time trying to predict.
Yeah, there's no doubt. Because now as we wrap up the year, if you will, I think the sentiment is completely different. There's definitely still concerns. And I think the way that we live our life and probably the way we value life and relationships has definitely changed. And hopefully it's been altered for the positive. But, vaccine is now out. It's being distributed. As we start to see test results, hopefully those things are positive and cases diminish. And, I saw a chart that globally was 1.6 million deaths across the world, which is just crazy. Those things are hopefully coming down, which all gives us more hope and optimism for 2021. Kind of like, let's be done with this year, and move forward.
But again, the point being, if you think about it now, most people would think of it linear. People are going to get vaccinated, therefore it becomes less of a thing. If that means if coronavirus is less of a thing, that means that the economy is doing well. If the economy is doing well, that means the stock market is doing well. Those are all very logical things to think through. But there's always a chance that there's some other way that this actually ends up going down. You could say the negative case would be, we start rolling out vaccines. It doesn't go as well as we thought. Maybe people start passing away. They pause the vaccine. What happens if that actually ends up being the case? And I don't know that would happen. But it's not that it's out of the question that something like that can happen. And then how does the stock market react to that, at least in the short run? So there's almost a million scenarios you could go through.
No doubt. But I think it hits on one of the things that we talk about often, which is not letting our emotions drive our investment decisions. So we did put together a couple little slides. I'm going to go ahead and share one that we have used this a number of times. The roller coaster of emotions. You remember this thing, and it basically plots out as you kind of come up the curve to thrill and euphoria. At some point, things are going to drop. Right. And you go through anxiety, fear, all the way to the bottom of hope. And it's almost like a business cycle as well. And from an investment standpoint, the two bubbles at euphoria, that's like your point of maximum financial risk. Things couldn't be higher, which emotionally you'd say, oh man, now I should be investing. However, things then fall off the cliff to despondency, which is utter chaos, probably from an economic standpoint, but a great opportunity to buy.
Yes.
Right.
And also, this makes it this is very clear. It doesn't always work this way. It's not so easy to pick euphoria and despondency, obviously. I think the more that you diversify your sources of information, you're going to start getting people that are both euphoric, and so you can have, if let's say that you're at the euphoria stage, you can have a lot of euphoria going around, but you could have a lot of people that are also more, not panicked, I guess, concerned, because they know this is usually pretty bad. So if you're kind of mixing your informational sources, it's hard to get a read on, there's no real like everybody's this way or everybody's that way. You will get a mix, but in a general sense, the average, I suppose, would be when everybody thinks there's no risk, that's when there's most risk. When people think there's tons of risk, that's usually when there's least risk, because people are kind of on their P's and Q's about what they're doing. So
yeah, that's a great point. And normally we've talked about this in the past as like periods of time, right? We were on a call yesterday and somebody made the comment about 2020 has felt like a 5-year period in 12 months.
yeah,
So I thought this was interesting. Just threw some graphics in here to go along with this. If you think of last year and towards the end, we had low unemployment. The markets were doing well, US and globally, as I mentioned earlier. Our rates were low, lending was up, real estate was kind of booming, businesses were opening up all over the place. So economic growth was fantastic. I would say there was definitely some euphoria in conversations that we were having with people.
Yeah, there was definitely a lack of concern. Like there was no, you definitely weren't at a panic stage for sure.
Correct. Then we start the year, and I don't know if my screen is in the way, so I'm going to move it up to the top here. Unsure of COVID was the U.S., deaths started to appear globally, travel bans, et cetera, et cetera. The market started dropping January, February. I felt there was, without question, anxiety and fear inside of there. And then as the year progressed, as we get into, again, the spring, it was really getting crazy. And March, April was one of the worst financial and economic things we have ever seen. And there's no doubt there was panic, despondency, loss of hope, really.
Yeah, I don't know the exact figures off the top of my head, but I know it was something like the worst jump in unemployment, monthly unemployment in ever. I mean, I guess as long as we've been keeping stats on unemployment filings, worst month ever. I think it might have been the worst quarter for GDP annualized, or month at least, ever. We went from unemployment in the 3s, maybe 4s, to 20, in 3 weeks or something. It was incredible. So, I mean, it was like off a cliff. There's no question about it. In 6 weeks' time, like it was very, very quick.
Right. I saw a stat the other day too, from a business standpoint, almost 43% of all businesses closed. It's pretty amazing. So we went through that. We got through the summer, and then I think we started rounding the bend as the talk of the vaccine was coming out. The markets were actually pretty resilient and started coming up. We'll talk about that in a second specifically.
Yeah.
Things were doing better. Yes, we had the election coming up, and that was still chaotic, I guess would be a good word.
Yeah.
But it seems as though, if you look at where we are today, and I can't put the arrow in a perfect spot, but we've had some hope. We feel like there's relief. Are we at optimism yet? I don't know. But to your point, that doesn't mean that this thing can't repeat itself. But I just think it's wild to think that in 1 year, we've seen all this.
From a stock market standpoint, the U.S. stock market standpoint, we definitely think we have. I mean, we've gone through the entire cycle of emotions in one calendar year, which is incredible. It's not even overlapping. It basically started in January and seems like it's kind of going out with a bang in December. I would say, as crazy as it was, how bad it was in March, it's almost as if we've taken a 180 the other direction. And you're seeing things like, a lot of people would say the end of a market cycle usually ends with what they call retail participation. So it's basically retail investors, which tends to be a little bit of a derogatory term, but basically, amateurs start getting involved in trading the markets. So you have, Robinhood is a newer trading platform, right. But it's really like across the board. We've seen, obviously we use TD Ameritrade to be clear, but TD has a retail side of their business, and it's like record account openings. So Charles Schwab, TD Ameritrade, Robinhood. I think a lot of that has been due to it's free to trade now. There's no cost to trade. So you can trade as often as you want. But also platforms like Robinhood, which have made it easier to trade options. So you can add a lot of leverage to your trades. And there's been a ton of that recently. And you see that showing up in things like, Airbnb, or even many IPOs, but Airbnb just last week, I guess, that comes out and it's up 150% on the first day. For those of us that were around like in the tech bubble era, 1999, 2000, 2001, it certainly reminds you of that. Where like
sure.
anything that's technology related or adjacent at all comes out the first day and it just goes crazy. Is that a sign of a little bit of frothiness, bubbleness, euphoria in the markets? I would say yes. There's definitely parts that seem that way, in my opinion. You've got a lot of these SPACs, which are these special purpose acquisition companies, which are basically they're basically IPOs. They just raise money, bring a company public, but it tends to be just an IPO in some sense, very speculative. Those things are going crazy. Some of these, they don't even have a company yet that they're taking public. They just have a bunch of cash to take a company public, and they're just going crazy. So there's definitely a little euphoria at the end, being that we've gone through this entire cycle of ups and downs in one calendar year, which has been just crazy to watch for sure.
Yeah. So, I mean, where do you go from here? From an investment standpoint, because on one end I think the tendency would be for a lot of people, well, I want to get involved in that. I wish I would have bought Tesla, or why didn't I should be buying more Amazon right now, because the trucks are all over the place and my door's going off the hook. So how do you weed that out and just kind of do what I would say is, somewhat boring allocation, diversification? Because really the markets have done great, right?
Yeah. I mean, we can look at some numbers. As far as like performance year to date, we broke it down by some different timeframes. To answer your question about what to do, I think there's definitely some of those companies, I could name 100 of them, that are very expensive. They're giant businesses. Tesla's always like a good example, but there's lots of those. There will be companies that if you took 50 of those types of companies, that they're trading at super high multiples, they've done really well. Some of those will end up being great businesses, but some of them will end up being zeros because they can't all collectively do really well. There's competition that gets involved. So I really probably would not recommend anybody doing that. If you're going to do that, you just need to know that it's highly speculative and you need to be ready to lose all your money, I guess, in some sense. So taking a big bet with a big part of your net worth is not something that I would really recommend. We're going to keep it boring. That's what we're going to do, is we're just going to stick to the process, diversification, rebalance, and we'll talk about that too. So, and we can even talk about it if you want to bring the numbers up. So,
yeah, for sure. Because I think it's interesting to see what the markets, if you will, I know we use that term pretty vaguely, U.S. markets, global markets have really done so far. And normally I'll preface it this way, we're sticklers for saying 1 year really doesn't matter.
Yes.
It's just not going to matter. If you're investing for, which I don't know that we don't have a single client that doesn't fit the 20 plus year investing, because if you're 65, 70, you need to be prepared to live longer unless you have super bad health. So this is more to correlate to the previous slide of the emotions and how wild it's been.
Yeah. Right. If you're investing and you have money and you're investing, I would just assume you're a permanent investor, because even if you're 65, 70, your money needs to last a while. But there's people that more likely than not are going to inherit something from you, and they're going to start the cycle all over. So, chances are it's almost a permanent investment. Not all of it, but certainly a portion of it. So, which is a totally different subject. So I'm not going to read all these numbers off. I think you can, a couple of things. If you want, whatever your persuasion is, you can look at these numbers and tell yourself whatever story you want to tell yourself. It's only 1 year. You could say, this means this is great. This means this is bad. You could read into this however you want to read into this, whatever your priors are. You can tell yourself whatever story you want. What I would look at this and see is that diversification counts and rebalancing is awesome. So if you look at the first column of year-to-date returns, you'll see that a couple of things. One is it's crazy to see that long-term U.S. bonds are the best performer of the year. Obviously, this is maybe from a day or two ago, and we're December, I guess it's the 16th, so we still have a couple of weeks to go. But long-term bonds being the best performer year to date, but being the worst performer since the bottom of the market. So they haven't done anything for 9 months, yet they're still the best performer. If anything, they've lost since the bottom of the market. So they've actually were up a little bit more the first 2.5 months of the year. But also something like U.S. value being the worst performer year to date, but the best performer since the bottom. This is a couple of days old. It's actually over 80% since the bottom. So, these things just, even in a year, they're all over the place. So we're always going to say that none of these things are really predictable. I always kind of beat to death 1 year is indicative of nothing. So drawing conclusions from 1 year is typically foolish, much less 6 months or a month or something like that. The other thing is, if you look, we did put since 10/30 on here. So that's basically since the elections, elections was the 2nd of November. So, if you were saying, I want to sit it out, see what's going to happen with the markets, let things kind of settle down a little bit. Well, some of these things are up. Like I said, these are a couple of days old. They're close to 20% now. Like, what are you doing? Are you getting in now? You just start playing games with yourself. Some of these things have the best November they've ever had. So if you were saying, I'll wait till the election situated to get back in, you're just going to drive yourself mad doing that.
I think all of these points hit home the last slide of the emotional things. It's just impossible leading up to the year. And I want to go back one because I didn't realize this until looking at the slide, which is great. Long-term bonds, most of you know that the values go in the opposite of rates. So rates go up, the value of the bond drops, and vice versa. Leading into this year, which we've been hearing for a while now, but anticipation was rates can't go any lower. They're going to go up. Therefore, bond prices will come down. It's probably not a good investment to be in, right? So if you followed that notion, you took money out of bonds, put it in the market, and by March, you probably were hammered if you're in the market. Meanwhile, bonds are up 25%. Psychologically, I would say, well, crap, the world economy is going to hell in a handbag. I'm getting out of the market. I'm going to buy bonds. They're up 20-some%.
Right.
So then you sell out of there.
Yeah.
You grab the bonds thinking that that's the safe, right move because they've done well. And then the column 323 to 20, you lose money in your bond, yet you watch all the other things skyrocket. Yeah, you talk about messing with your mind.
Yeah.
And this is exactly why we don't do that. We do, unfortunately, the boring asset allocation and things of that nature.
Yeah, right. Yeah, all good points. I mean, we can jump on the last one here. I think it kind of leading into this is there's always talk about the boring. If you're a Wheel of Fortune fan, you'll know, when you get to the final round, they give you some letters, R, S, T, L, and E, because everybody used to always pick the same letters. So they just started saying, we're just going to give you those. And then you get to pick the last three in a vowel just to add your own kind of spice to it. So I always joke around that some of these things are just givens. Like, this is a given. This is what we're going to do. The spice is going to be your personal plan and the things that are important to you. That's where you're going to add some spice in. But as far as like investing, there's givens. In my opinion, it's diversification, rebalancing, and having realistic expectations. If the stock market has returned between 6 and 7% over the long run, like the 100-year long run, it would be foolish to think that you're going to get 10% permanently. It's not impossible. And if you do end up getting that, you need to be comfortable that you're going to get tons of ups and downs and how difficult it's going to be to stick through that. I could use a million examples, Amazon being one. There are multiple times that Amazon was down 90%. Do you think that you would have handled that well in the moment to say, oh, I'm going to stick with this for the long run when it's down 90%? That's just very difficult to do. over the long run. So kind of going back, one example is, talked about a little bit of euphoria. If you look at the like tech stocks, the NASDAQ, I guess, the NASDAQ since 2010, so the last 10 years, it's up 20% a year or something like that.
Right.
Roughly, which is incredible.
It's mind blowing.
It's incredible. It's up 45% or something this year, which is amazing. It's just amazing.
So I should start investing in it now, right?
So you would say, well, the last 10 years has been great. I mean, I could tell you a million stories why that would continue. It's Amazon and it's Apple. Like, it seems these are obvious stories that would continue. The thing is, if you went back the previous 10 years, so the leading up to 2010, it was down 4.5% per year. So, you start with $10,000 and you end up with $6,500 roughly over 10 years. You would have had to be the kind of person to say, look back and say, this thing has been horrible for 10 years. I'm going to invest all my money in this thing and then ride it all the way up. The lesson to take from that is, well, what has been a horrible thing for the last 10 years that everybody hates? That could be the next thing that's going to be a ride for 10 years or something. I don't know what that is. It could be, who knows? It's Japanese stocks. It's brick and mortar retail. Everybody thinks they're dead. Malls are dead. Brick and mortar retail is dead. Everything's online. Maybe it's brick and mortar. It's department stores or something. Who knows? Just something that everybody hates. It's energy companies. Like, there's a million things. What are those things that everybody hates that have done really, really bad for the last 10 years that you could make the case that these are dead industries that will be the next thing that takes off? I don't know. Maybe it is tech stocks. I really don't know. But over the long run, that full 20-year period for tech stocks, you've gotten like 7% returns. So a long-term return in tech stocks with tons of up and down, you got yourself about 7% is what you got. So your expectations to think that maybe you can jump around and catch the best thing, I just think you're fooling yourself to think you can do that with any consistency, and not probably get blown up most of the time. So
yeah, no doubt. And best case scenario, probably just a really wild ride.
Right. A really wild ride up and down, and you still lose money.
Yeah, exactly.
So stick with the basics.
Stick with the basics. I think 2020, as we can sum it up, has been, as you've listened and lived, a pretty crazy and different year. Next year may be different. Hopefully it's better. Hopefully you've grown this year. I know we as a firm have, in terms of our ability to do things differently, communicate, grow with clients. Personally, I think we can all say that hopefully there's been some positives through this, in light of all of the negatives that we've gone through. From an investment standpoint, we would say, let's keep doing what we're doing. Make sure we're mindful of why we're investing, what its purpose is, how much time we have, and that we have a process in place.
Yeah. So we're going to keep diversifying. We're going to keep rebalancing, and we're going to have realistic expectations. And the things that we're really going to pay attention to, the things that we're going to focus on, the things we're going to put tons of mental effort into are, well, what is important to me? What is the purpose of this? What am I trying to accomplish? Those are personal to you. Those are your 3 consonants and a vowel that you're adding to the givens. Those are the things to focus on, because those will be individual to you, and the way that you're going to do things will be impacted by that. Whereas the investing is pretty much going to be the same, in my opinion, for 99.9% of people. So focus on the things that matter to you. Focus on the things that are important to you, and then backfill what you're going to do with your investments and how you're going to invest your money based on those things, kind of going forward. So hopefully that helps. One other thing. We tried to make this so it wasn't so, here's what happened, here's what's going to happen. If there are things that you want us to make videos on, if you have like investment topics, I suppose, email us and let us know, or however you want to tell us. And I'll do the best we can to make videos on those topics. So if you have specific questions, let us know. We'll try to hit those things as much as we can and not make it too dry and boring. So.
Right. Great point. Reach out to us. Let us know. Thanks for joining us again. From all of us, I guess, Jack, this is probably our last 2020 Avid Chat. So
yep.
Hope you have a Merry Christmas, a Happy New Year, and we'll see y'all soon.
Yep. See you guys next year. See you, Dave.
Right. Hey, buddy.